Thanks for checking out this video from NetPicks. And today I'm going to talk about the Parabolic SAR. Interesting little indicator by J. Wells Wilder. And you can actually use it for a few purposes. Number one is determine the trend. You can actually use it for trade entry signals and also for exit signals. Now the SAR stands for stop and reverse. It's shown by a series of dots, as you can see, above and below the price. So it's really designed for traders that are always either long or short in the market. So if the parabolic SAR is plotting dots below the price, well, price is in an uptrend. If plotting above the price, we're going to consider price being in a downtrend. So here's the calculation for it. And one thing to know is that it actually uses the extreme price values for this calculation. As obviously you can adjust the settings to suit your needs. The start value, that's where the acceleration factor will start at, generally 0.02. The acceleration factor is how much the original value is going to increase each time a new high or low in the trend is plotted, right? The extreme price. The max value prevents the acceleration factor from increasing too large, pretty much making the indicator whipsawing back and forth. So when the price begins to move with larger price jumps, the SAR begins to plot on a more extreme curve angle, as you can see on that last up move in the chart here. Now, a common question about every single trading indicator is what's the best setting? And again, I repeat this over and over again. There is no best general setting, right? Each trader is different. So if you set the acceleration factor far too high, the dots come closer to the price action, you get quicker buy and sell signals. For some, you guys might like that. But quicker signals equal more whipsaw, which is something we probably don't want to be trading as a trader. So I always suggest with every single trading indicator out there, just start with the default settings. And if you feel the need to go down that rabbit hole and make all these adjustments, just start from there. Price moves in trending moves and goes into trading ranges. And many indicators will do well in one market state as opposed to the other. The SAR is a much better indicator to use when we have strong trends as opposed to price action back and forth in a range where it's whipsawing. You get a lot of false signals, as you can see here. Now, what about using it for trend direction? That may not be the best use of it because you can look at the chart on the left and see that the trading conditions are not a great one, right, as the one on the right. So market conditions matter. Now, the common approach when you're using the parabolic SAR for trading signals is to trade when the dots break. For example, when the dots flip from the top to the bottom of price, you'd want to exit any short trade you're on and flip to longs if you're a stop and reverse kind of trader. Now, it's easy to see that when the trend's running, the buying or the selling of the flips works pretty well. But once we get into that back and forth price action with price bars, it can be pretty painful, right? So using the indicator for buy and sell signals is not really a successful approach if you blindly take those trades. And we're going to examine one adjustment that we can make to better filter out the trades. Before we get that, let's talk about stop loss. Now, using this for a stop loss for losing trades or even as a trailing stop, that may have some merit. Now, this is an example of simply exiting a long trade on the candle close after the parabolic SAR flips to the downside, meaning the dot is at the top of the price. So the danger of this method is the candle that closes that confirms the flip may actually have a larger than normal average true range, right? So it could turn a winning trade into a loser if it's a huge momentum candle that flips the parabolic SAR. So a trailing stop, now this would be my preferred method. And all you do is you trail your stop up on each plotted dot. Now, this example would have had you out later than the flip exit method. You don't have that risk of giving back too much if the momentum downside candle steps in. Another bonus about this one is you only have to check in with the market at the end of every candle close to adjust your stop. So for some of you, that might be every 5 minutes. For others, it may be once a week. What about using a moving average with it? Will it give better results? And my answer to that is yes. Now, counter trend trading can be done, obviously, right? There's specific times, however, to do so. But for most traders out there, following the longer term trend is a much better way to go, especially if you're just starting out. So if I use a moving average as a trend following indicator to show the current trend direction, only take buy and sell signals from the parabolic SAR in that direction of the longer term, I'll probably have better results. So in this example here, I'm just using a 20-period simple moving average. It's gold futures. You can use any length of moving average you want, right? It's all depending on your trading goals. There are two main ways we can define the trend when looking at a moving average. We can look for the direction of the slope of the average, up or down, or flat. If price is below the average, that's a short. If it moves above, that's a long. So in our example here, there are 5 parabolic SAR flips that were ignored as the moving average did not confirm the trend direction, which in this case is price over or under the average. Now, the one issue that is apparent is that the flip can happen when price is extended too far from the moving average, as you can see on the left over here. So that may be pretty far away to be entering a trade because we're expecting some sort of retracement. So what can we do to ensure that we have an objective way to recognize that price may be too extended and looking to reverse? Let's toss in the Keltner channels. This is a 20-period Keltner. Bands are set at 2.25. So if you see that price is extended close to the upper or lower band, you'd ignore the first signal. Wait for price to pull back to around the moving average on the channel. That red X, that shows price below the average, and the parabolic SAR dot is on top of that candle. This would be a short trade, however, price movement has driven to the low of the channel. So expecting a retrace because price is so extended, you'd not enter that trade. You'd wait for a better entry. Well, so now we have to define what is a better entry. Let's keep it simple. Look to enter a trade when price touches the moving average. This is the same chart. Price pulls back to touch the average for a potential short trade. Place a sell stop order below the low of the candlestick and wait for the potential reversal and a trigger into the trade. Now, aggressive traders, you may decide to trail the entry up, which may get you in earlier depending on your stop loss location. Let's talk about dynamic support and resistance. Those words drive me nuts because it's an illusion. Some people attempt to sell traders on the idea that moving averages or bands or even the parabolic SAR are acting as dynamic support and resistance. They don't. It's a calculation. So when you see price seemingly act as support or resistance, what you're seeing, again, is the result of a mathematical calculation using a variation of open, high, low, close, or just one of them. So if the close, for an example, of price is roughly the same over the last several candlesticks, maybe you're in a trading range, well, eventually the moving average is just going to catch up to price. So while it may look like it's a barrier to price, it really isn't. Once you accept that, you may find yourself having a different feeling towards risk management and actual price structure. Is it a viable indicator? There's some things I like about this indicator. I think it keeps you objective in terms of trade entries. When you use the acceleration factor, that can help you lock in profits when the signal you took is moving in your direction. There's no guesswork, right? It's either there or it's not. If you're thinking of tweaking the settings, oftentimes the default settings are good enough. There may be other technical analysis tools like candlestick patterns and actual price support and resistance zones that could prove useful. Now, using a moving average as a trend determination tool can keep you from getting whipsawed because it's going to cut down on the buy and sell signals that are plotted. The Keltner channel, I think it is a great addition when you're using buy signals and the sell signals of the parabolic SAR. Hands down, I'd want to use something like that. All right, let's wrap it up. Any questions? Pop them below. Of course, I'll always respond to legitimate questions. Hope you like it, subscribe to it, and we'll catch you in the next video.